Well, so topic of the day is solvency ratio of insurance companies. Solvency ratio of insurance companies. So life insurance companies offer various life insurance policies to safeguard the financial stability of your loved ones against any unfortunate event. So more than 20 life insurance companies are active in the insurance sector. That is total 24. And no two are alike. Several factors make an insurance company stand out in the crowd, like various types of plans, low premium cost, attractive risk covers, death benefits, additional riders, and more. But before purchasing from a life insurance company, the question an insurance seeker should consider is whether your insurer will be able to settle your claim if the day really comes, and how do you judge it? So this solvency ratio can help the insurance seeker ensure that the insurer is trustworthy, reputable, and sound in providing financial support to loved ones in urgent hours. And that can be judged by the solvency ratio of that insurance company. Now, what is the solvency ratio? When an individual purchases life insurance, the insurer promises to pay the nominee a predetermined sum in case of any unfortunate event with the policyholder. So, on considering the regular mortality rate in a year, the company can easily manage the expenses when paying the claims. But in odd conditions like natural disasters, floods, earthquake, tsunami, etc., the number of claims submissions will be higher due to the damage caused. So to ensure that the life insurer is eligible and can bear the claims, the inflow, outflow, and liability of the company are measured, which is termed the solvency ratio. So in simple words, the solvency ratio is a metric to assess the financial health of the company, to pay debits and meet other financial obligations, both long-term and short-term. So keep this in mind while buying an insurance policy, that the company with a high solvency ratio have a higher tendency to meet its financial obligations. So to make the judgment easy, the IRD has mandated all insurance companies to maintain a minimum solvency ratio of 1.5 to access assets over liabilities. What is mandated? A minimum solvency ratio of 1.5 to access assets over liabilities, termed the required solvency margin. Now, how to calculate the solvency ratio? The simple way to calculate the solvency ratio of a company is to divide the company operating income after eliminating the taxes by the company's debit liabilities. So the formula of the solvency ratio is equal to net income plus depreciation upon all liabilities, short term and long term. The formula is solvency ratio is equal to net income plus depreciation upon all liabilities, short term and long term. So what are the types of solvency ratio? So financial professionals evaluate the financial soundness of a life insurance company with the 4 types of solvency ratios. 1. Debt to asset ratio. Debt to assets. So debt to assets ratio calculates the debt of an insurance company in comparison to its total assets or earnings. So the formula is used to calculate the debt to asset ratio of the company is debt to asset ratio is equal to debt upon assets. Simple formula, debt upon assets. So a debt to asset ratio of more than 1.0 indicates that a business may struggle to pay its debts. You are getting the point? A debt to asset ratio of more than 1.0 indicates that a business may struggle to pay its debts. The second one is interest coverage ratio. The interest coverage ratio assesses how the company covers the interest payments, which highly depends upon the debts. So one can use the formula to calculate the interest coverage ratio, and this formula is interest coverage ratio is equal to earning before interest and taxes upon interest expenses. I repeat, interest coverage ratio formula is earning before interest and taxes upon interest expenses. And how to judge it? Companies with an interest coverage ratio of 1.5 or less may struggle to gain funding from lenders. Companies with an interest coverage ratio of 1.5 or less may struggle to gain funding from lenders. And third one is equity ratio. So the equity ratio indicates the extent of the finances of the company to determine if it can pay debts. This equity ratio decides the financial picture of the company after paying off all the outstanding amounts. Use the formula to calculate the equity ratio of the company, and that is equity ratio is equal to total shareholder equity upon total assets. Total shareholder equity upon total assets. And to judge it, a high equity ratio shows that the company uses a minimum of debts to finance its expenses. You getting it? A high equity ratio shows that the company uses a minimum of debts to finance its expenses. So the debt to equity ratio means that debt to equity ratio determines the total debts of the company to their equity or earnings. The formula is debt to equity ratio means total outstanding debt upon total equity. A low debt to equity ratio implies that the company has low debts against its outstanding shares. Now, what is the solvency ratio? Why is the solvency ratio important in life insurance? Why is the solvency ratio important in life insurance? When you buy a type of the insurance plan, whether a term plan, ULIP plan, whole life plan, retirement plan, endorsement plan, or any other, you sign a legal contract in which the life assured agrees to pay a decided amount known as a premium. So in return, the insurance premiums to pay a sum assured in case of any unfortunate event. Now, if the insurer becomes the insolvent or bankrupt, they might be unable to pay the assured sum when required. In such conditions, the family of the insured may struggle financially. So, hence, to ensure the financial well-being of your family in an hour of urgent need, it is important to look for the solvency ratio of the life insurance company. A higher solvency ratio indicates that a company has adequate assets available to cover its liabilities and it is better positioned to pay off its debts over time. So how can you find the solvency ratio of an insurance company? Since the solvency ratio is an important metric to measure the financial strength of the company, accuracy is crucial. So the solvency ratio of a company may fluctuate over time. Hence, consider the latest information available. You can find and compare the solvency ratio of the different life insurance companies from the sources like insurance company's official website or IRDAI list. Because to get a clear picture of the solvency ratio, you can get in touch with the insurance companies to get information related to their finances. To check it online, you can directly go to their official website and visit the investor relations section to learn about its solvency ratio. And if you want to go to IRDA list, the IRDA releases an annual report highlighting the key metrics of the life insurance and general insurance companies. You can find important data related to the solvency ratio of the claim settlement ratio to compare the assets and financial performance of the company. Here is the updated list of the solvency ratio of all the insurance companies if you want to understand. Because this is the information which is authentic and latest one. Say for example, I show you life insurance companies. The highest solvency ratio you can say in December 2021 was 6.04 of Bajaj Allianz Life Insurance Company. That is in March 22, 5.81. So this is amazing, wonderful this is. Very good one. Secondly, the Pramerica Life Insurance Company Limited. Pramerica Life Insurance Company Limited. Pramerica Life Insurance Company Limited. This was having 3.86 in 21-22 and now in 22-23 it is 4.04. But higher than all is of Sahara India Life Insurance Company Limited. That was 9.23 in 21 and 6.75 in 22. If you are interested to know the solvency ratio of LIC of India, it is 1.77 in 21 and 1.85 in 22. But the financial stability of LIC of India is the highest. No doubt, it is beyond doubt. So, solvency ratio is one metric to check the financial ability of the insurance company and meet short-term and long-term debt obligations. However, only the solvency ratio doesn't give the whole picture, and you need to look at the finances from a holistic viewpoint before selecting a life insurance company. You can look for their customer services, organization setup, liquidity ratio, claim settlement ratio, and other measures to make an informed decision before investing. So this is one factor which will give you some idea, because IRD has mandated the minimum solvency ratio of insurance companies. It must maintain 1.5. So in terms of solvency margin, required value is 150%. The solvency margin is the extra capital that company must hold over and above the claim amounts they are likely to incur. It acts as a financial backup in extreme situations, enabling the company to settle all claims. So the solvency ratio that life insurance companies declare every quarter reflects their ability to honor their promise of sum assured in case of any unfortunate event. Also, to cover your family's current and future financial assets needs, you need a term insurance plan or any other plan, because the affordable premiums allow you to buy a large coverage for your family regardless of your budget. And solvency ratio provides a clear picture of an insurance company's overall financial health. It takes into account the company's liabilities, cash inflows and outflows, Solvency ratio on insurance companies help you understand whether the company can manage its financial responsibilities effectively or not. A high solvency ratio signifies stability, reliability, and long-term financial security. So, a financial stable insurance company is less likely to face insolvency. This means the chances of your claim being rejected or you losing money is less likely. Is less likely. So life insurance plays a very important role in securing the financial stability, and they must have the 150% solvency ratio, that is 1.5. Thank you very much.